You are the trillion-dollar man. That is a high bar. That is a hefty target to grow your business by $1 trillion in the next 10 years. What's the single most important thing you need to do to get it done?
Look, I think, Dani, there's a really powerful shift underway in credit markets as it relates to a trend towards private financing. And so the momentum we're seeing in our business is a result of that. We see it in our traditional private corporate direct lending business, but we increasingly now see it in what I'd label private investment grade. The market we've been very active in for our large institutional and insurance clients, where we finance assets across a very wide and broad spectrum of collateral types, consumer finance, infrastructure, digital now with data centers, equipment. And so the asset-based finance market, which is a much larger addressable market, $25 trillion or higher, is a very large opportunity for us. And given our scale and our size, with about $420 billion on our platform in credit and lending at Blackstone today, it gives us this really unique position to take advantage of what's happening.
As you're expanding into these things, it feels a little bit different than the history of Blackstone credit. You think of the GSO days, maybe the sharp-elbowed, a little bit more high-flying risk type days. You, of course, your background is one of insurance, coming from Global Atlantic. So is the Dellaert era of Blackstone credit, is it a more moderated risk and dare I say even more boring era for Blackstone credit?
It might be more boring, and boring is okay. I would say, look, it started well before I took on the job and a role under John's leadership and with Dwight, driving the business more into a performing credit a business platform across a wide variety of asset classes. And that's a continuation we've seen, and that's what we've been driving. And so if I think about our business today, we've evolved to be a one-stop shop capital solutions provider to borrowers. Given our scale and our size, that makes us very relevant. And ultimately, growth comes from the fact that we do a good job for our investors. We do a good job, they try to come back for more. And that's what we've seen. We've seen growth in all three types of our client base. Institutional, where we have really deep roots, insurance, where we recently crossed over $200 billion, and then individual investors who are still allocated in small parts to this ecosystem. And so we're seeing growth across the board, large part, in addition to direct lending and private credit, this mega trend that we're seeing around private investment grade, and really the reallocation that investors are going through away from public bond markets into private credit, where they can earn a little bit more.
Well, as you're making that push into investment grade, into asset-backed finance, it is a different type of deal, as we've discussed. A lot of it feels like it needs bodies on the ground to do those sort of infrastructure type things, whether it be autos, airplanes, that sort of thing. So are you hiring like crazy right now to do that?
We've hired a lot of people. Our team has expanded significantly, not just in the US, but I would say globally as well, because what we're seeing here is starting to happen in Europe, and it will follow in Asia. We're in the very early innings of all of this globally, I would say. And you need talent, you need expertise. That's what we stand for. Our view is if we hire very talented individuals with relevant product expertise, we can build great businesses around them and deliver for our clients, and that's what we've been doing.
Is there any risk in more people going into this? Because you're not the only firm I've heard that wants to do more IG, that wants to do more asset-backed finance because of this shift to insurers. Is there any risk with more types of people and more money floating around in this market?
I don't see it that way. I would say, in large part, what we do in that market is single A rated investment grade credit. And we generate it in private form, and that gives our investors 200 basis points or so more than what they can earn in the public fixed income market. In a way, it's no different than when people started to reallocate from public equity portfolios into private equity. And that's really a trend that's only started a few years ago with insurance companies, but we're now seeing it spill into our pension clients, sovereign wealth clients, and other people that say, hey, wait a minute, I can earn a little bit more for the same or a better risk profile. Why don't I go do that? Because I don't need the liquidity in a portfolio where I have 10, 20, 30-year liabilities or long duration investment needs. And that's what's fueling it, really.
Well, one very clear trend since the GFC is more private lenders, more non-banks taking up market share. This is the stat from PitchBook. 86% of leveraged loans in 2023 were done by non-banks. It was 61% in 2019. That's already a huge amount of growth. But banks are starting to come back. They're starting to come back into lending in a big way. So if they are, does the private market hold on to 86%? And if not, what's a more realistic share?
It might not be 86% in leveraged loans, but it'll become a much larger portion in the broader asset-based finance markets and the infrastructure finance markets. And so there's a lot of growth and room for potential opportunities there. What I would say is ultimately what we do, we're always going to coexist with banks. We're great partners to them. You saw us announce in Q1 a number of partnerships with Barclays, with KeyBank, real win-win situations where what we brought to the table was highly complementary, solved a need for them. And I think you're going to see us do more of those types of partnerships.
But it can't all be buddy-buddy. You're competing with them at the same time.
There might be situations, but for the most part, look, we borrow from them, we pay them a lot of fees, we see opportunities from them, and we source risk from them at large still. Certain borrowers will sometimes come to us directly, and that's what you'll see, and that's what I think ourselves as well as some of our competitors have gone through. But ultimately, we don't think that this is a model where one needs to beat out the other. There's enough opportunity to finance broadly defined all these markets and coexist with one another in a very structured and constructive way.
So does that mean you don't need to do things like cutting fees, like sweetening terms in order to fend off some of the bank competition?
Look, I think this year spreads have tightened because public markets in large part are back. And I think that gives borrowers a great choice to be able to say, look, I want a public financing deal or I want a private option where there's maybe more execution certainty and it comes with other features. And that choice is a good thing for the financial system. And so ultimately, a year like last year, when that wasn't necessarily as available, you saw more flow come to us. Today, it's maybe a smaller percentage and there's more going in the other direction. But through cycles, that will ebb and flow, and you'll see markets where the percentage will be higher certain years than other years. There's plenty to go around despite all of that through the cycle, as we think.
So the IMF wrote a paper earlier this month, and you will not be unfamiliar with their hypothesis at all. The idea being that private credit remains untested, but untested in its current size. And not necessarily that it poses a systematic risk, but to the individual investors who've invested in perhaps a bit more risky, but over-leveraged and illiquid and non-transparent type assets. Do they have a point?
Look, I would say we probably see it slightly nuanced or different way. Lending in itself is not a risky thing. If you have the right protections and you do the right loan level underwriting work. Our performance ultimately speaks. If you look at our default rates, we've seen zero default so far this year in our private credit portfolio over the last 12 months. In our non-investment grade portfolio, where we finance over 2,000 companies, we've seen less than 40 basis points. That's a fraction, 90% lower than what you see in the public market. So if you have the right expertise and you position your book defensively, and that's what we've done into this cycle and this environment, you can persist. You may see some bifurcation of performance, and you've started to see a little bit maybe early in Q1 in some of the BDCs. You've seen some slightly more elevated default performance in the lower middle market. Where you invest ultimately matters. And so our focus has been, we like to finance large companies that are better positioned to weather the cycle. We like to finance them in sectors that have strong tailwinds, where there's strong growth, high free cash flow generation, sectors like software, business services, the energy transition or renewable energy arena. And if you do that well and stay away from things that are maybe more capital intensive or cyclical in this part of the environment, then you build a resilient portfolio, and that's what we've done.
But at the same time, we've had a Fed that, by all accounts, is shifting gears. They're getting ready to go higher for longer. And a lot has been made in this environment about a maturity wall coming in 24 and 25. I understand that your portfolio, you feel is safe, you're not concerned. But for the industry as a whole, does that maturity wall all of a sudden look a lot steeper and a lot more dangerous?
I think there's less leverage in the system than there was in prior parts of the cycle, right? If you look at pre-GFC, financings were being done at 65, 70, 70% plus LTV. Today, in our direct lending business, we're financing large companies at 40 or 45 LTV. So you're starting in a very different environment than you were maybe back then. On rates, I would say, look, rates being high has been a tailwind for credit allocators. They've been able to earn high risk-adjusted yields, which has been a good thing. Will that invariably put pressure on certain businesses? Absolutely. We're seeing that. We're seeing the economy slow a little bit. We're seeing inflation be more sticky. The pace of disinflation slowing. Eventually, the Fed will cut, but they'll be deliberate about the pace and they'll be measured about it. And we've invested at Blackstone in credit for nearly 20 years now, through high and low rate environments performance through cycles that were both, challenged or less challenging, and ultimately performance speaks, and that's how we've built
Right.
our business.
What happens, though, if we don't get cuts this year or next? Presumably, there's going to be some pain in the industry, and is that pain you could take advantage of?
Certain companies will need a bit more runway, will need a bit more of an extension of, say, their first lien unitranche paper. They may need a piece of mezzanine debt or preferred security. So we're getting ready for that. I don't think you'll see a massive slowdown, but you'll see a slowing top line and bottom line that we've kind of started to see play out a little bit here as we sit here today. So we're getting ready for that, but it's not necessarily going to be a recession type that we've seen, in the GFC of the likes. We think it's going to be more measured.